Hello friends. Today I am going to discuss on how to finance your trucking business like a pro. The trucking industry is the bedrock of any economy, without which industries can perish and countries come to a standstill. Trucking as a business can be one of the most profitable ventures, but given that it is capital intensive as well as operationally cost heavy, it is imperative that startups and trucking companies evaluate their financial requirements and get access to the right financing at every stage of the business. Efficiently financing your trucking business involves the following 2 steps. Understanding and choosing the right financing option, short-term and long-term. Acing the eligibility criteria. Understanding and choosing the right financing option. Short-term cash flow financing. Freight bill factoring, FBF. Typically, payments in the trucking business are delayed, with clients paying up as late as 60 days. However, operational expenses are continuous, which results in a cash crunch that could cripple the business even before it takes off. In this situation, you could choose finance your freight invoices, for the freight that has been already delivered, via freight bill factoring. The lender would provide as much as 90 to 97% of the invoice upfront, and the balance, less the fee, once the client pays up. In the US, you can avail this facility if you have a reasonably good credit score, even if you are in business for less than a year, provided your client is creditworthy. Short-term working capital loan. When you need to grow your business by taking on new contracts, you can opt for a short-term loan to tide over the immediate expenses such as labor, fuel and other running costs. These loans have a repayment term of 36 months with weekly payments. They usually carry no penalty for prepayment but may come at a fixed interest charge. To avail this facility, you need a good credit score and must be in business for at least a year with an annual revenue of at least $100,000. Small business line of credit. This serves as a quick source of working capital for recurring cash flow gaps, without unnecessary charges. You can borrow and repay multiple times without reapplying, and fund all your short-term expenses as they come, be it new runs, fuel expenses, insurance payments, unexpected repairs etc. You only pay interest on the amount you borrow. You can avail this facility for an amount less than $100,000, repayable within a year, at interest rates ranging from 13 to 20%. Eligibility requirements are the same as for short-term loans. Business credit cards. As in the case of any credit card, you can float your operating expenses for a period of 30 days without interest. You can use this card for fuel purchases, toll payments, insurance etc. These cards charge interest at 15 to 29% along with an annual fee. However, most of them offer attractive cashback rewards and 0% introductory offers. The maximum credit limit is generally not more than $30,000, but the lenders will evaluate your credit score, annual revenue as well as your monthly expenses, before deciding your eligibility and credit limit. Owner/operator startup loan. In the US, these are SBA guaranteed loans for amounts up to $5 million, with lower interest rates, 8 to 11%, and longer repayment periods, up to 10 years. However, additional loan packaging and guarantee fees are applicable. You could be an absolute startup or a mature business looking to fund new truck purchases, or expanding to a new geography or hub. You do need to have a good credit score, but most importantly, you need to be able to provide collateral for 50% of the loan amount, and be able to pay at least 10% of the loan amount as a down payment. You may also be expected to independently finance up to 30% of your total startup cost. Equipment financing versus leasing. Equipment financing is suitable for trucking companies looking to grow their business by buying new trucks/trailers, replacing existing ones or starting a new trucking business. It covers expensive equipment purchases, up to $500,000, has low interest rates, 6 to 9%, and long-term repayment, as per the useful lifespan of the vehicle. The vehicle being purchased is used as collateral in this case. Additionally, you need to be able to pay a down payment of 5 to 20% of the cost. For those who cannot pay up the down payment, and are not sure if they will need the vehicle after 3 years, leasing the equipment can be a better option. Leasing offers more flexibility, lower monthly rental payments, and less time commitment, but comes with mileage restrictions and mandatory maintenance guidelines. Moreover, insurance rates are always higher for leasing. In contrast, if you opt for a loan, you build ownership equity every year, and once the loan is paid, you own an asset that can generate profits for you. Acing the eligibility criteria. As is evident from the above, whether you choose a loan or short-term financing, there really is no substitute for a good credit score. Nonetheless, how do you ensure your access to the best financing at the lowest rates? Here are some ways in which you can build leverage and tilt the scales in your favor. Choose a quality vendor. You could always buy a truck from a private party, but if you choose to buy from an established dealer, the lenders will be assured of a standardized paper trail and proper truck evaluations, making their decision easier. Go for a newer truck. The older the truck, more the expenses on wear and tear, repairs and breakdowns. In contrast, new trucks will have better mileage, and more modern fixtures and tools for driver assistance, viz., automatic emergency braking, lane assistance, lane departure warnings, cruise controls, etc. Ensure a revenue uptrend. Lenders prefer to see an increasing revenue trend for a period of 3-6 months, so ensure that you receive key invoice payments just prior to the application process. Get optimal insurance coverage. If you already have insurance coverage on your existing fleet, it gives a positive signal to lenders. Also, in many cases, you need to secure insurance for new equipment before the loan amount gets credited in your account. Reduce operating expenses. The lenders want to see a healthy net operating income, for which you need to minimize operating costs on your existing fleet. You may not be able to do anything about fuel prices, but you can reduce fuel expenses and maintenance costs by adopting an efficient fleet management system. This system will help in efficient routing and monitoring mileage performance. Similarly, you can set up vehicle maintenance schedules in the system to regularly check oil changes, engine tune-ups, and inspect the braking, transmission, and electrical systems. Demonstrate high safety standards. If you invest in the right hardware and software to ensure safety, lenders will know you are committed to high standards. The best GPS fleet management system will not only monitor your drivers for safe driving practices, but also ensure that your vehicles are tracked in real time on a map, and have the necessary panic alarms and alert notifications in case of an accident, theft, or emergency. Thus, choosing the correct financing option and ensuring optimal financing of your trucking business can be an overwhelming task if you are just starting out, but with careful financial and business planning, and a firm commitment to long-term goals, you can not only repay your loan faster but also enjoy long-term profitability of your capital investments. Keep in touch. If ever you need any kind of help or assistance, you can send us an email at info@fleetroot.com. Get your free demo at fleetroot.com. Please like and share this video as well as subscribe to our channel.